Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, the reason we monitor is because we might have to exit a trade, maybe before we planned, maybe right on schedule. We might have to adjust, if necessary. Adjusting, well, I kind of touched on that a little bit before when I said, one exit strategy might be, hey, I'm going to buy a call today, and then if the market moves my way, I might later sell a different call to roll into a call spread. That's what you call an adjustment. Now, adjustments can be part of a plan like that, like I just explained, or they can be done on the fly. Sometimes the situation changes. Oh, there's political turmoil here. I've got to change my plan a little bit. I used to have on a credit spread. I'm going to roll this into a butterfly or something. For adjustments, there's, my goal right now is to sort of make everybody aware of what they are, but I could spend a whole 3-hour presentation just on adjustments alone. Some of the techniques are rolling, where you buy one option and sell another option to kind of change your position. Some types of adjustments are legging in, like the example going from a call to a bull call spread. That's legging into a bull call spread. And some are legging out. You might have a spread on, and a classic example is maybe I have a debit or credit spread. Yeah, well, let's say a debit spread. And the short option, because I'm long one option, short another, maybe the short option is offered at like a nickel or a dime. Well, it doesn't make sense to leave that just kind of sitting there. So maybe I'll buy that back and I'll leg out of the trade. And sometimes I just morph it into a different position altogether. So now the final step here is exiting the trade, and typically that ought to be going according to plan. If things change, you might have to do an adjustment, which is changing the trade, but ultimately getting out of the trade. There's obviously not too much to say about that, but that's sort of the last step. Now, I told everyone that I would spend a little bit of time at the end here answering questions, and I do have some time. I've got about 6 or 7 minutes. I wanted to tell everyone really quick about my mentoring program here at Market Taker Mentoring, LLC. Here's what you get: 9 one-on-one mentoring sessions, including a personalized assessment and consultation, plus a total of 9 one-hour personalized education sessions with me, schedule permitting. If too many people sign up, you might have to wait until I get an opening, but with me personally. Weekly customized homework. I send you out my book, Trading Option Greeks. And also, I've got lots and lots of educational material on my website available only to students. I've got videos that I require all my brand new students to go through. I have some PDF tutorials on volatility because that's really important. And I've got about 30 hours worth of archived webinars that are very, very specific to the things that my students need to know. So I encourage people to enroll, to give me a call if you have some questions. I'm going to give you my contact information right here. And for people who have attended this webinar today, I do offer a discount. I offer a $200 discount, which makes a big difference. So if you have some questions, send me an email at dan@markettaker.com, or you can call me later on. This is my business number right here, 815-922-3329. Okay, so I want to see if I've got any questions.
Hey, Dan, I have a question regarding your mentoring.
Oh, yeah, sure.
So, let's just say that John Smith is at the webinar today and they're interested. Mm-hmm. So then you set up sort of a free session with them to decide if their goals are attainable based on your mentoring.
You know what I do sometimes, and I'll tell you what, Steve. This is what I'll do for people in this presentation. Usually, what I do is once people enroll, I send them out a free assessment.
Okay.
It's after they enroll, so it's part of the program. What I'll do for people watching this presentation for your people, you send me an email and ask, and I will send you the assessment that I send to my paying customers. I'll send that to you for free.
Wow.
Yeah. And basically what it is it's kind of, it's my own personal way of figuring out, who you are as a trader and what your goals are and whether mentoring is practical for you. Because, for some people, you might have other means or you're not there yet, you're not ready for mentoring. This is kind of part knowledge test, part psychology test. Who's your broker? How often do you trade? What kind of trader are you? What's your risk tolerance? And I kind of get to know you and see if it's practical for you.
Wow. That's a great offer, guys. So if you're interested, what's the best way to get a hold of you, Dan?
The best way is just to go to my email right here, dan@markettaker.com. Or, like I said, if you call me later, I will likely answer that number, and you can talk to me personally, and I can get you set up with a free assessment.
Perfect, yeah. I do see a question, and I know we don't have much time, but Dan, why don't you take this one? How about if you talk about, you can't really talk about volatility without talking about skew. I know skew, you can talk about skew for hours and hours, but can you just talk briefly about skew and how you look at skew when you're trading the markets?
Mm-hmm. Sure. Skew, we can talk about two different types of skew. One is your horizontal or your time skew, and one is your vertical or your strike skew. And, when you look at volatility charts, and again, the whole premise of this presentation was to be very, it was kind of introductory to some people who are kind of new to the idea of volatility and some concepts. But when it comes down to really fine-tuning and really using that, the volatility charts, those are your starting points. If it says right now the volatility is 20, well, okay, that's a great starting point, but when you actually trade the option, it might not be exactly 20 because, maybe the July options are 20, but the August options are only 19. The volatility of different months can be different for different options. And that's called your horizontal or your time skew. And to that same point, you might be looking at an at-the-money call or an out-of-the-money call and deciding between those, well, which one should I buy? Well, maybe one has a 20 volatility and the other one has a 21 volatility. The volatility among options of different strikes can be different as well. So understanding volatility skew and step one is just knowing that it exists and paying attention to it, because you can see the volatility numbers right there in the option chain if you have an option-friendly broker. And so, if you're buying an option, you might think about buying one with a cheaper volatility. If you're selling an option, you might think of selling one with a higher volatility, because that's really the relative measure of the price of an option.
Thanks.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.